and then I'm going to hand it over to the experts. Welcome.
All right, thank you. Hey, I thought I would just take it over here. Thank you, Nick, for joining us. Justin Botillier, CEO of Calyx CPA. Jamie is my business partner, tax extraordinaire. And then, of course, we've got Nick Richards, the esteemed, very popular tax attorney. Nick Richards joining us. Thank you. So actually, I think it was Jamie or my idea that we need to do a continuing education. We need to get the cannabis accounting community together because we're kind of on like this tail end of 280E. I think we're thinking maybe next year, mid to late next year, when cannabis ultimately gets rescheduled to Schedule 3, 280E is no longer an issue. I imagine almost everybody here by now knows what 280E is, I hope. And so this is definitely like a 301 or 401 level college course, but it's a lot less about maybe educating you and more like just stating the facts, because I think at this point, we need to do something. And we need to give our clients the facts and then let them make a decision about whether or not they want to take the risk of being aggressive with 280E. And so we put together a slide deck, which I'm going to go ahead and turn on here pretty soon. And it kind of goes over the tools that we use now to mitigate 280E. It also goes over the various constitution, whether or not the Controlled Substances Act is constitutional. And that's why Nick, thank you, Nick, for joining us, because I'm hoping that Nick can speak on that. And so I guess what I'm going to do right now is I'm going to go ahead and start this. Let's see, share presentation. We put this together. So Jamie and I put together quite a bit of material so that you guys can download this, and it can be found, correct me if I'm wrong, it can be found at handouts up at the top right. And in there is a slide deck so that you can download these slides and view them for yourself. But I mean, what it is it's just kind of a comprehensive presentation about all of the tools that the cannabis industry has to move forward with potentially challenging 280E. And so, and that's, you know, and that's what I think we want to happen, because here at Calyx, we're pretty aggressive. We've been aggressive with our use of 471C. We are giving our clients the option to move forward without reducing deductions for 280E, and we're even giving our clients the option of amending returns, tax returns. And so, but we don't want to be alone in this, and that's really what the point of this presentation is that we don't want to be in a very small minority of people who are willing to give our clients the option to do this. And the approaches that we have are defensible. We don't know what the risk is, but we have to assume that it's high, because we don't know what it is. We've never been, you know, our use of 471C has never been challenged. Our, you know, we just recently started amending tax returns to not reduce deductions. We're moving forward without reducing deductions. We don't know what the risk is. The IRS will definitely give you the impression that the risk is very high, because I constantly see articles about like attorneys saying, no, it's the worst thing that you could ever do. And then of course, IRS agents saying, hey, we're going to go after you. Okay. So what the facts are, I don't know. But today I'm hoping just to introduce the facts. All right. So with that said, let's move forward with this presentation. So a lot of this presentation is kind of the background. We don't need to let you know what the Controlled Substances Act is, I hope, because that's, I mean, essentially it is what has created, it is what makes cannabis a Schedule I drug and makes 280E applicable. So I'm just going to kind of skip ahead. Now, this is slide decks available for you, so you can download it and you can peruse it for your entertainment at a future date. But so let's start here. It's interesting. We've come full circle here because I remember, and the reason why we chose Tax Pros, John Shealy's organization, is because I remember the first continuing education I went to was about 10 years ago, and it was in person in Denver with John Shealy. And at that time, it was very interesting because I went there, I flew there, and when I got there, the education was pretty much, this is 280E and you're screwed. That was the that was the information that I got. And at that time, Oregon was just rolling out its medical dispensaries. And so when I started doing tax returns and applying 280E, I'm like, wow, this is insane. There is no way that this is real. 90% effective tax rate. There's no way that these dispensaries are going to be able to survive at that point. But what was nice about this Denver continuing education is that I was in a room with other accountants from California and Colorado and Washington, and they had been exploring this. And we jumped on 263A, which, as you know by now, that we don't use it because in the code it says that if deductions are otherwise disallowed by another code section, we can't use 263A. And correct me if I'm wrong, Jamie or Nick, if I say anything that's incorrect. But what we then did was we landed on 471A. And in it, we were able to kind of like go like, hey, well, if we allocate expenses, if the payroll, if the staff are packaging and bagging and weighing in the back and doing inventory handling, well, that payroll is deductible. And when they're up front, then that payroll is not deductible. And then we were doing these complex like square footage maps and saying, okay, this square footage is not deductible, that square footage is deductible. And then the tax returns were bonkers complicated. But that's what we had to do. And whether or not it was defensible, that was up in the air because I read plenty of articles that said, well, this is a retail business, not a manufacturing business. So were we even doing it right at all? But ultimately, I had a tax return that was challenged to 471A. We used 471A. It was challenged. And ultimately, they were like, the IRS is like, well, what is a reasonable cost of goods sold? And they gave us some of it, right? They didn't totally. It wasn't a bloodbath. They just said like, hey, we'll meet you in the middle. We think you took too much, but we're not going to like shut you down. But even then, it was an outrageous tax rate, 70%. And it was only until 2018 when the Tax Cuts and Jobs Act passed where they passed 471C. So let's see here. And I'm going to I've talked a lot already, and thank you for listening. But Jamie, do you want to talk a little bit about 471C?
Sure, yeah. So 471C was, an additional section of the code, and specifically inventory like valuation methodologies that are allowable on tax returns. And the intention of 471C was really simplification. It's for businesses that are considered small businesses, which are actually quite large to the average Joe, right? So I think it started at 26 million average revenue over the past 3 years, and it's been adjusted to about 29 million now. So any business, with 29 million or less in revenue is eligible, to use 471C to value their inventory. And in short, it's a very short code section, but in short, it basically says if your books and records match what you report on the tax return, it's an acceptable methodology for valuing inventory, which is way different than what we were dealing with before, which was very specific, very not expansive inventory accounting rules, and especially limited for retailers, where the code really said, the code along with the regulations that interpret the code really said retailers can only take your direct cost of product and, you know, maybe shipping costs. As Justin mentioned, there was kind of a reasonableness kind of applied to that. And really the IRS was kind of allowing, you know, certain reasonable allocations of payroll, some other items and cost of goods sold, but really it wasn't, you know, supported by regulation. So this was a huge opportunity. The accountants in the cannabis industry saw 471C as a huge opportunity. You know, reading it, there's a lot of talk about, oh, wow, we could just, on our books, we could say, let's put everything in cost of goods sold. We'll call everything cost of goods sold. And no 280E will apply anymore. You know, this is the end of 280E. And, you know, that's a pretty aggressive interpretation of it. But, you know, I think in a way it could be argued. Shortly after, you know, I don't remember the exact timeline. Shortly after that was released, and, you know,
it was 2021 or
21.
You know,
Yeah.
when the regulation.
Oh, yeah,
Nick? Oh, you're muted.
I think you're muted.
Can I interrupt real quick and just give a little bit of lawyer piece on 471C? So some important things to understand about 471C. When we talk about full absorption accounting and the 471A regulations, right? Those are regulations. Those are methods. 471C is the law, right? And so if you're out there going, wait a minute, what they're saying conflicts with GAAP or conflicts with full absorption accounting, guess what? You lose, because 471C is the law, and the regulations are a lesser authority to the law. That's really, really, really important to understand, because 471C is this remarkably crazy code section that says some things that, when we have our accounting 471A hat on, don't make sense.
Yeah.
But look, 471C, I'll use the word, trumps 471A. And here's why. The first thing that 471C says is that 471A doesn't apply. Right? And so that's really important, because it says that the 471A law, the regulations, full absorption accounting, all of that stuff does not apply by law. That's really, really, really important to understand. You got to take off your full absorption accounting hat. You got to take off your 263 Cap A hat, because none of those rules apply under 471C. Okay, and it's really important to understand that. I'll stop there.
Well, and the reason why this is important is because when we were using this, you know, when 471C passed, and Nick, thank you so much for being like introducing this to us properly. We started using 471C, and our office, and I'm going to just spill the beans here, was taking 100% of payroll, 100% of facility costs, all other costs that were related to the transactions that were, the costs that were required to transact, make transactions in dispensaries. We were taking all of it. And here's the thing about it is, like you were saying, Nick, that 471C's rules are very clear, as long as it is in conformance with the books and records of the business. As long as your inventory methodology is, you have a reasonable inventory methodology. And I saw there was a lot of people who were taking 100%, and I think that's what ultimately caused the IRS to step in and say, like, hey, we need to close this loophole, which I think you spoke on, Nick, that they did try to do that, but that's not tax code, right? It doesn't say.
Yeah, Justin, what they did is, so there was this TIGTA report that came out.
Yes.
And that TIGTA report sort of said, hey, IRS, 471C is pretty dramatic. These people are saying it can eliminate 280E. Why don't you issue some regulations on the interplay of 280E and 471C? And then I see your regulations slide up there, right? When those regulations came out, guess what they didn't mention? 280E, right? Nowhere do they mention 280E. Yeah. So that was quite dramatic to see TIGTA tell the IRS to do this And then when the IRS did it, it didn't reference 280. And that was fairly remarkable when taking in context of what 471C says, right?
Right. And they sort of tried to, it seems like they tried to imply it, right, without actually saying it. And that's kind of the theme we've been getting from the IRS the last several years is they're like implying it's not allowed without actually really saying it. So as we kind of mentioned here in the slides, the wording is like, if, for a cost that would otherwise be non-deductible or non-recoverable, you can't use 471C to, transform it into an inventory cost that's eventually deductible as cost of goods sold. And, Nick has put out several great CPEs or webinars on his position about whether, disallowed costs are otherwise recoverable. We won't go into that too much, but either way, I think it's just really interesting. So they issued this, they sort of tried to imply it won't work, for cannabis cannabis industry without specifically saying it. And there's multiple ways you can argue that the regulation doesn't really apply here. But one argument is kind of as Nick mentioned is just that the IRS doesn't have the authority to just contradict the code. Right. And so regulations have a lower authority than the code. And so we can look to the code, which is very simple and says, 471A does not apply. And we are able to use an inventory methodology, on the tax return that just matches our books and records. Justin, did you want to chime in?
Yeah. I mean, and I don't mean to interrupt, but I just, 471C should not be new to most people. At this point, because the fire is almost out, and so 471, the real benefits of 471C was like over the last 4 or 5 years, right? So now, but the reason why we're going over this is because it's still a viable option for the next couple of years. We still want people to use it, but at that time, we were getting so much like, hey, you're putting your clients at risk. It's not a matter of if, it's a matter of when you get audited. It's gonna be very costly with lots of penalties. And knock on wood, that has not happened. And Nick, I wanted to talk to you just a little bit, ask your questions too. Maybe we should have asked this beforehand, but have you seen the fallout of the use of 471C? Has there been significant, has the IRS been punitive with companies that have used 471C? Have they attacked those cannabis companies and has it cost us greatly? And that's a slightly rhetorical question but I don't know, you might surprise me.
Well, so first off, I don't file tax returns, and so I'm gonna say first what I hear from a lot of the CPA partners that I work with.
That's what we want to know.
And what I'm hearing is that, hey, look, we haven't had any audits of 471C taxpayers. In fact, I've heard some of them say, look, it seems to us that we're still getting audits of our non-471C taxpayers, but not our 471C taxpayers. So I've heard that from a number of CPAs out there. And why might that be? Again, it takes the IRS. I didn't say this though. What 471C does is it takes the IRS's power away, because what 471A says is that the IRS shall determine cost of goods sold so to clearly reflect income. So when 471C says 471A doesn't apply, it takes that power away from the IRS. It also gives the taxpayer a very key power, because what it says is your books and records have to match your tax return. And if they do, that it, quote, shall not fail to clearly reflect income. That's the end of the story. That's our income tax system, right? Once you clearly reflect income, the tax is applied, right? There's nothing else to talk about once income is clearly reflected. So it really takes the IRS's power away in a big, big, big way. And for that reason, maybe we understand why they don't seem to be wanting to audit 471C taxpayers. Now, that said, I have had some. The main thing I do is handle audits and tax trials and tax debt and all that kind of stuff. That's why I I'm an expert in 280E because there is no regulations on 280E, right? And I've had hundreds of 280E audits that I've handled. Some of them have been 471C audits. And really kind of what happened is that, the IRS targeted the cannabis industry and they built all these audits. And then they cherry picked all the big good ones. And then COVID hit. And then they're like, God, what do we do now? We don't have anything to do. Well, what about that list? Let's go back to that. And then they did all the rest of them. And in the rest of them, there was some small businesses that got passed over in the first time, but then they picked up, and lo and behold, there was 471C. And so I think I had about 6 of them, I want to say. And what I have found, I think I've got 3 no changes of those 6 and 3 that the IRS wanted to challenge. And what we found was that if the books and records were good, we got no changes. If they weren't, we got a challenge. And then as Justin said, then we backed into let's be reasonable, and we settled those cases, right? Yeah. So that's kind of, we don't have any law on 471C, and the no changes that I've received, they're not binding legal precedent or anything like that. Yeah. But Justin, to answer your question, doesn't seem like the IRS wants to go after 471C taxpayers. But right about the same time that 471C came out, I think the IRS made it known that it was going to only audit larger businesses over 25 million. Strange coincidence there? I'm not sure.
Yeah.
But that's where we are today.
And Nick, that's really great insight. And I just wanted to add, from a practical standpoint, as our firm Calyx has been preparing tax returns using 471C, since those final regulations were issued that some say, would maybe disallow the cannabis industry from using 471C, we've been filing disclosures with every tax return that we file. And I don't know if the attendees are familiar with the different kinds of disclosures, but there's a general disclosure called an 8275, and then there's an 8275R, and the R stands for regulation, and it basically is telling the IRS that you're specifically taking a position contrary to the regulations that it has, published. So we have filed every single tax return that we've prepared, hundreds. I don't even know how many, Justin. So many using 471C, and everyone has included this 8275R. And so there's a lot of talk, people often ask me, what's a red flag? Is this a red flag for an audit? Is this a red flag? And I, can basically never answer yes. Like nothing, I don't think it's clear what is or is not a red flag, but I can give some insight into certain things. An 8275R is absolutely a red flag. It's probably like the only, at least in my experience, one of the only things I can say, surefire red flag for an audit, because you're telling the IRS you're specifically taking a position contrary to what they believe is the correct position, essentially. And so that just really speaks to that idea that the IRS does not want to audit those returns. I mean, we've been almost, it feels like our firm has been begging them to audit us almost with the number of 8275Rs that we've filed. And we have not seen any audits yet of those returns. So really interesting.
And Jamie, let me add one more thing. The position has gotten stronger this year with the overruling of Chevron, right? The Chevron is a case that has said, basically, we'll let the IRS say what they think 471C means, if it came to that, right? Now that Chevron's gone, the IRS doesn't have the authority anymore to sort of reinterpret the law, right? And if there's a direct contradiction, which there appears to be here, the IRS is going to lose without Chevron in quite a significant way. And so, even we started doing this 3 years ago, right? And it's gotten even better in the last year with the overruling of Chevron. So it's quite interesting. It's quite interesting how this road has gone for us.
Can I ask you a question, Nick? And first of all, there was that 8275. Oh, Jamie disappeared. Was always a request. An 8275R was a request to be audited. I love that when people would tell me that. Shoot, I just forgot what I was going to ask, but it's going to come to me. Okay, so I have a question, because we do disallow like discretionary spending kind of things, advertising, professional fees, interest most of the time, insurance, some of those kinds of things. I mean, we would we deduct a lot. We deduct a lot, but we always were really good about throwing the IRS a bone and saying like, hey, we won't deduct advertising. We won't deduct these things because they're not, they're not like instrumental to transact actions. But there was a lot of people for a while that were putting 100% of everything into their inventory calculation 471C methodology, everything, 100%. And then just recently, I was looking at a couple of tax returns from new clients of ours, and there's a company, a pretty well-known cannabis company that's putting it's the first time I'm seeing them use 471C, but they are now putting all of the costs into inventory. So my question is, are we safe now, potentially, for at least the upcoming tax season next year for 2024 to include all expenses into inventory?
Is that a question for me?
It is kind of.
I'm not going to talk about whether we're safe or not, but I'll tell you what. I'll tell you what the 2023, how an additional way that the position got stronger in 2023. Okay.
Yeah.
And this is a little bit of what we're going to talk about with Raish and the amended
we're going to definitely get into all of that.
I'm not going to. This is a little bit of a part of it, but this is really a 23 go forward method. Whereas the race challenge is more a go back and file amended returns.
Yes, exactly.
So a very interesting thing happened in 2023. We got the HHS report and recommendation to reschedule to Schedule 3, right? That was leaked in 2023. Later this year in April, right, we got the proposed regulations issued by the Department of Justice and those included the HHS report in them. And we also got an opinion from the Office of Legal Counsel as well. All three of those were released. If you go on to doj.gov, they're all sitting there, or dea.gov. So why is that significant? So first off, that Office of Legal Counsel advisory opinion, right? The government needed that because we had these treaties out there and there was all this talk about how rescheduling would violate treaties. And there was also the 2016 determination by the DEA not to reschedule marijuana, right? And so the Department of Justice wanted some advice around that, right? And of course, the advice was the treaties are okay, don't worry about that. And the two things, the 2016 determination not to reschedule cannabis was based upon the wrong test, right? One of the big things about a Schedule I drug is it's a dangerous drug that, blah, 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 that doesn't have a currently accepted medical use. Really, the only difference between Schedules 2 and Schedule 1 is a currently accepted medical use, right? And so the test that the DEA used in 2016, according to the Office of Legal Counsel, was wrong. It was impermissibly narrow. And when they used the right test, there was a currently accepted medical use, and cannabis is now proposed to be rescheduled to Schedule 3, right? So that's really quite interesting, right? That they fucked up back then, right? And really, reading into that a little bit, they were wrong, right? That was the wrong result back into 2016, right? So what else? So the other thing they said was that the opinion of the Department of Health and Human Services was binding until the proposed regulations were released. And then it has, in legal terms, substantial deference, meaning it's a big evidentiary mountain that's hard to overcome, right? Mm-hmm. This is, after all, the government's own internal report on marijuana, right? And so that has a lot of weight against the government. It'd be hard for the government to get around that, right? So 280E, right? What that report says is that marijuana doesn't meet the definition of a Schedule 1 or Schedule 2 drug, right? It meets the definition of a Schedule 3 drug. Mm-hmm. 280E does not say it applies to substances that are scheduled as a Schedule 1 or Schedule 2 drug. It says it applies to substances that fall within the definition of a Schedule 1 or Schedule 2 drug. In 2023, the U.S. government said that marijuana doesn't fall within the definition of a Schedule 1 or Schedule 2 drug.
Mm-hmm. Interesting.
No.
Right? So
that's been my question all along. Why in the hell has it ever been
are people
21?
just putting it all in there now? Maybe that, and you asked me, is that safe? Is that justified? That would be my argument that I would use to say that beginning in 2023, 280E no longer applied, and under 471C, we can now put it all into cost of goods, or perhaps just report it as a normal business, right? But that's that argument. It's quite compelling, right? Because you know, you look at what 280E says. It doesn't say a scheduled substance. It says falling within the definition, right?
Yeah,
So that report was issued August of 2023, right? And so does it apply to all of 23, or does it just apply 24 moving forward? Those are some questions that we have. It's very interesting, Justin. It's very interesting that Jamie, you probably saw this, that notice that was issued about a month and a half ago that warned the industry about filing amended returns. Guess what it didn't say? Right? It said, hey, the idea that rescheduling is retroactive and you can file amended returns and ask for your money back, that's wrong. It didn't say anything about 2023.
Yeah.
Interesting, right? It's oftentimes more interesting with the IRS doesn't say.
Yeah, I think it said 280E still applies, and marijuana has. It was very strategically worded, in my opinion, where it said, you know, marijuana hasn't. We're reminding taxpayers marijuana has not yet been rescheduled. 280E still applies. But it really didn't speak to the actual argument that, like, it should not apply. You know, it's saying, you know, if people are filing returns just assuming, like, misinterpreting the proposed rescheduling as actual rescheduling, that was kind of the interpretation Justin.
Well, as being retroactive, right?
Yeah.
That was it's not retroactive.
It's not retroactive, right? And
Yeah.
then, of course, Justin always likes to argue too. You know, if we find out now it doesn't fall, you know, it doesn't fall within the meaning of a Schedule 1 or a Schedule 2 drug, it really never should have, right? So that is something, Justin, just from a common sense standpoint, maybe not as good of a legal argument, maybe not as good of like an accounting argument, but really from a common sense standpoint, if we realize we messed it up, it never should have been classified this way, right? And so, you know, that's part of kind of the mindset that gets us into, should we go ahead and amend? Should we argue? I think a lot of people can agree that it's at least reasonable that 280E should not have been applying. So all these years, right? So do we go ahead and take that risk? Do we argue it and see if the IRS is really willing to fight us on it? They say they don't agree with the position, and we know that, right? Like, we don't need them to say that. We know they don't agree with the position. Our position is that we disagree with it. Like, we disagree with them. So we're ready to fight, kind of, is where we're coming from. So it'll be interesting to see if they do actually, you know, audit and then challenge these actual real legal arguments that are saying we don't believe it should apply, even though technically the law is written that way right now.
And that was why, Jamie, that was why I started out with the Office of Legal Counsel saying that 2016 determination was based on the wrong test, right, Justin? That is your support for your argument that we should be able to go back, right? If that's your argument. But I think that's quite compelling, actually. And, you know, there's all kinds of other stuff out there as well that you could put your fingers on that shows that it was wrong. And interestingly, if you read those proposed regulations, what they say is that the DEA wouldn't act, right? And so the DOJ has to go around the DEA, or DEA works for the DOJ, right? As part of the DOJ. But they say basically, yeah, DEA they wouldn't move, so we're doing it. Well, guess who else wouldn't move? The IRS, right? The whole federal government took a hands-off approach, except for the IRS, right? Maybe DOJ to move on the IRS too, right? Maybe that's the basis of this retroactive push and request that the industry is making, right? I think there's something there. I think it's a way long shot, but I think there's something there. I like August 2023 though. Moving forward.
Yeah, absolutely.
Yeah.
And then Marijuana Moment, which is a great publication for people who may not be subscribed to their news articles, put out an article finding somebody found audio recordings of Nixon. Now, I don't know if it's AI generated. I trust this publication, but AI is so crazy. You could do anything with it, and you can put words in anybody's mouth in history, in overall history. But he pretty much was saying like, hey, marijuana, he was saying, I don't know if marijuana should be included as a Schedule I drug. He was saying, I don't see it's that dangerous. That's what he was saying in that. And then, but the group that he was working with, his counsel, was like, no, we need to eradicate this from our great nation, right? And so they threw it in there. So yeah, I mean, if the HHS and these other organizations are like, hey, no, this shouldn't be a Schedule I drug, then the federal government has done immense damage to people, to this industry, immense, you know. The amount of money that was sunk and lost into this because of this issue. And it just seems like everybody else was hands off, just like you were saying. Federal government's like, hey, you know, you just do your own thing in your own state and we'll leave you alone. But not the IRS. The IRS is all over you, right? So anyway, let's move on because we've definitely went to the next to the next part of this conversation, which is moving the reasonable basis argument. Do we have a reasonable basis for moving forward without reducing deductions for 280E? And do we have potentially a reasonable basis for going back and amending returns along with our other larger, you know, industry leaders, trailblazers, Trulieve and Cureleaf and Ascend, and these other large corporations that are amending their returns? Trulieve got their money, and moving forward without reducing deductions for 280E. I'll pass it over to you, Nick, if you want to take the lead on this.
Yeah, so you know, it all started maybe three years ago or so when the Supreme Court denied cert on a case called Standing Akimbo, and Justice Thomas took the opportunity to say that Gonzalez v. Raich may no longer be good law because the facts have changed. So Gonzalez v. Raich is a 2005 U.S. Supreme Court case that basically held that because the federal government had an interstate policy of eliminating marijuana from the United States, Justice Thomas called it a watertight policy. That because of that was this overall interstate policy and goal, that it was justified in preventing an intra-state, in maintaining illegal effect Schedule I on cannabis intra-state commercial activity, right? There is no federal right to regulate drugs. And the U.S. Constitution states that any power not specifically given to the federal government is reserved for the states. And the only way the federal government has the right to regulate drugs is through the Interstate Commerce Clause. So the question is, does that interstate authority allow them to regulate intra-state activity? Because as you all know, our industry is not interstate, it's intrastate, right? So Justice Thomas said, hey, look, the facts have changed. That started this process, this very large, very prominent litigation firm called Boies Schiller Flexner approached the cannabis industry and got involved in some of the high-level groups that were out there and said, look, you guys need to fund us to bring a case to challenge Gonzalez v. Raich. That happened. That's a case called Canna Provisions. It was filed in the fall of last year, right about the same time as when Trulieve made their announcement. And Canna Provisions is directly challenging that Gonzalez v. Raich and the federal government's ability to regulate marijuana under the Controlled Substances Act, right? So the argument goes like this. Again, the basis of it's sort of remarkable, right, for the federal government to infringe upon a state's intrastate authority, right? The Constitution doesn't say they can do that, right? So there has to be a good reason, right? There needs to be some good reason. In 2005, you remember, they were locking people up in California and Oregon and elsewhere, right? And so they were maintaining this watertight policy of illegality, right? Now, 20 years later, there is no watertight policy, right? As we well know, the federal government has its hands-off approach, everybody but the IRS, right? And that is seen through various pieces of evidence. For example, the Rohrabacher-Farr amendments, right? Defund the Department of Justice for enforcing the CSA against a state legal cannabis company. The Cole memos, right, say, hey, we're going to take a hands-off approach. The authorization of Washington, D.C.'s program, right? All of those things happened very early on. I think the first Cole memo was 2014. That might be the first Rohrabacher-Farr amendment as well, right? So those go way, way back, right? More recently, some other things have happened. The hemp industry, right? The carve out of hemp from the Controlled Substances Act has created a huge industry where you could buy legal THC products in convenience stores across the country. As a matter of fact, what I read in MJ Biz was that every state but 2, you can now buy legal THC products, and the hemp THC products are oftentimes stronger than what's allowed in the state regulated system, right? So the dynamic has changed super dramatically. And then, of course, now we have the HHS report as well, right? And so the cannabis, back to what's going on in the courts right now, the cannabis provisions case now, when they filed that case, they challenged Gonzalez v. Raich. They raised this change in facts, and the federal government responded with a motion to dismiss and said, hey, look, first off, you're right. The Controlled Substances Act isn't being enforced. And so for that reason, guess what? You have no damages. So you can't sue us. Number 2, Gonzalez v. Raich is binding Supreme Court precedent, and the district court can't overrule the Supreme Court. So you got to grant our dismissal. So there was back and forth on that and the oral argument and all that kind of stuff. And right about the time, right, almost the same day that the IRS released their warning publication, right, the opinion came out from the court. And what the court said is there is standing because you do have the potential for damages. Number 2, Gonzalez v. Raich is, you're right, it's binding Supreme Court precedent. We can't overturn the Supreme Court, so we have to dismiss your case. You're right. But the court also went out of its way to say that the arguments were, quote, persuasive. That was a big deal, right? Persuasive is got to be higher than reasonable basis, right? I don't think it's a technical tax opinion term, but it feels better to me, right? So that all happened, right? So that there's something there, right? That it's not, we're not there yet. Well, that case will be in the appeals court by the end of the year. It'll probably be in the U.S. Supreme Court by the end of next year. Look, it is a compelling argument. And let me say one more thing. There was a recent, those of you out there lawyers, I'm sure there's a few of you might remember this case called Wickard v. Filburn from law school. It's a weird case. Basically, it gives the federal government the right to stop farmers from growing wheat for their own personal home consumption. Because if every farmer went out and did that, nobody would go to the store and buy Wonder Bread, and that would affect interstate commerce, right? It is a case that the conservative court hates. And if you Google Wickard v. Filburn, you'll see all kinds of conservative think tanks writing opinions about how it's the worst thing that's ever happened to our country. It is the Supreme Court opinion that Gonzalez v. Raich is based upon, specifically. And the court is now not following Wickard v. Filburn. And just like in the Controlled Substances Act, there is no federal right to regulate the environment. The only way the federal government gets to regulate the environment is through the Interstate Commerce Clause, right? And the Interstate Commerce Clause also applies to the avenues of interstate commerce, things like interstate rivers, right? And so there's a case from last year called Sackett. In the Environmental Clean Water Act, think of that farmer with that wetland way out there in the middle of nowhere, right? That farmer wants to fill that wetland in and build some homes, right? A lot more money there. But guess what? The federal government goes, no, those are navigable waters of the U.S. And for that reason, we have jurisdiction under the Interstate Commerce Clause and under the Clean Water Act, we're going to say no. So they went to court on that. And, there's been a lot of cases on that. And the farmer always loses. As a matter of fact, I think they've gotten up to sort of 12 miles away from any interstate waterway because underground, all the water's connected, right? And so look, if every farmer fills in their wetland, that'll affect this waterway, right? Because it's all connected underground. So the court, and that's based on Wickard v. Filburn, the court didn't go there. What the court said is, we don't care what's underground. We don't care what we can't see. If we can't see a connection, if there's no surface water connection, if I can't get in my canoe and paddle from the wetland to the river, there is no interstate commerce jurisdiction. There is no, so there has to be a direct, visible surface water connection. We don't have that in cannabis, right? There is no direct interstate
Justin, you're muted.
Right. So that is a great case showing the direction in which the Supreme Court is going and how it might rule if it again got to consider.
Yeah, and we only have 10 minutes and we've got 24 slides. But on the screen now is kind of what you're saying is if this, when it gets back to the Supreme Court, you think that the Supreme Court will rule in the favor of the plaintiff versus what happened in 2005 with Gonzalez versus Reich. Would you say
I think there's a reasonable basis to conclude.
There's a reasonable basis to conclude. Exactly. So I'm gonna burn through these slides, and again, these are available to you. And the list just goes on and on, really. So there's some other constitutional, there's some other, do you want to speak briefly on this, Nick?
Yeah, let me just say on the 16th Amendment, right? That's an argument that's been out there for a while. I'm sure you all looked at it. It got all the way up to the Ninth Circuit in a case called Harborside, and the Ninth Circuit said, it's not an issue. We're not going to talk about it. So it's still a live issue as well.
It's still
and the
alive.
real question is, is 280E constitutional under the 16th Amendment because it taxes more than gain realized, right? Simple example, if I have a joint, I buy it for $2. I pay Justin, my bud tender, $2 to sell it. He sells it for $5. I only made $1, but I get taxed on $3. And is that gain realized, right? And so that's the 16th Amendment argument. Just real recently, about 2 months ago, we got a decision in a case called Moore, Moore. Moore involved the TCJA to take care of all of these tax breaks that the cannabis industry got from 471C. The federal government had to find a revenue somewhere, right? And so what the TCJA says is that the federal government can deem a taxable event for U.S. owners of undistributed foreign corporation income. Basically, if you're a U.S. owner of a foreign company, foreign corporation, and it's holding income and not distributing it to you, we can deem you the recipient of flow-through income for tax purposes, right? It sounds like there's no gain realized there, right? So that was the challenge to the court, and this violates the 16th Amendment. The majority opinion punted. The majority opinion assumed that gain was realized because it was realized by the corporation, right? And the only question was, once there is gain realized, can we attribute it to an individual owner rather than a company? And the answer is, yeah, we can attribute it to anybody we want at that point. But interestingly, 4 Supreme Court justices wrote separate opinions specifically saying that gain and realization was required. Right? They went out of their way. They didn't have to do that. 2 of them were concurring opinions. And even though they agreed that it could be attributed, they went out of the way and they said, we're disappointed we didn't address this point because it's really important and it's required. And then 2 justices dissented, right? So that's 4 of 9 saying it's required. Meanwhile, only 1 justice said it wasn't required. The other 4 assumed it was already satisfied, right? So that's a big deal in the 16th Amendment argument.
So the list goes on, right? And so I'm just going to go through again. Like, people can download these slides. We've put links to stuff in there. We talk about the companies pushing back. This is even outdated. I think they're as far as like what's been going on. I want to get to statute of limitations and those kinds of things. Like, what are we doing now? Like, and again, we at Calyx are not looking for anything here. We're not looking to benefit from this except for encouraging other accountants to finally advocate to their clients if you have not started doing so already. Not because you're afraid of punitive damages that the IRS may impose on your clients and you, right? And again, we encourage 8275 to argue put your reasonable basis in there to not reduce deductions. We encourage you to make sure you use an 8275 if you're going to use a 471C approach. Okay, so we're getting there.
Let me chime in for a second. I'll chime in for a second and say we may not have time to go over it, but we did include an example of a tax return that uses 471C. It includes 3115. So I want to just touch to some of the technical aspects of it. To use 471C, if your client has not previously used it, you have to file a 3115, change in accounting method, for it to be valid. And you need to do that with a timely tax return for the year that you're wanting to change that method. And that's a really important piece because it's a very easy way to invalidate a method if you don't do that. And then that's, an easy argument to say, oh, you can't use 471C. You might get audited. It's not that 471C doesn't work, but it's that you didn't correctly ask to change your accounting method. So we've got an example of 3115 in there. We've got the 8275R that we file, and I've included some references in there to try to kind of guide you guys through the various aspects of the return that are important. And I've also included an Excel template that we use. So one question we got asked here in the Q&A is about whether or not you have to actually even capitalize any inventory under 471C. I think it's a great question. I think that you could probably argue, I'm sure you could argue, I'm sure Nick could argue that you don't need to have an inventory balance because, your books and records, that's how you value it. You don't track it, but you do call it all cost of goods sold. We have always taken an aggressive approach in that we take 100% of facility costs, 100% of payroll costs for simplicity purposes, but we do also try to make it a stronger position by including a portion of those costs in inventory. And the way we do that is we take there's different ways to do it, but the way that we do it is we take like an actual direct inventory balance that the client can provide us of actual product on hand at year end. And we come up with a percentage. So we take it over their total purchases for the whole year to get a percentage, say like there's 10% on hand out of the total purchases in the year. And we apply that same percentage to all the indirect costs that we're including in cost of goods sold, just to try to make our position a little stronger, really have it running through inventory, and then ultimately becoming cost of goods sold. Because cost of goods sold really is a calculated figure based on inventory, right? It's not meant to be, just its own thing. It's supposed to be calculated. So I've included an Excel spreadsheet that we use that kind of, you can plug in your numbers and get those different numbers, indirect inventory, direct inventory. And you can see on that tax return how it kind of flows, the 1125A, ties to the 8275R, which ties to that Excel spreadsheet. Like I said, unfortunately, we won't have enough time to really go over it in depth, but hopefully you guys can take some time to look at that. We've found that in a lot of the CPE we've taken, there's rarely ever actually an example of how to prepare these returns. And so we're really hoping to provide that so that more people who, maybe want to move forward with this approach, but are kind of unsure how it actually looks, can try to do it. So go ahead, Justin. You can take back over.
Well, just do the best that you can. We've been doing it for a long time, and it wasn't super clean at the very beginning, right? But it's just something we've refined over time, every tax year, every tax season. But we're definitely entering a new level right now, and really, it's a lot less about the 471C approach. People should have been doing that a long time ago, but they got scared, and that's really what's super unfortunate. I'm just now seeing clients who've been screwed over year after year after year. Their accountants have now started taking a 471C approach, and the fire is like out on 471C, right? 471C is now the conservative approach. So now we're talking about amending tax returns or moving forward without deducting for 280E. And we feel like very similar to the way it was back when the Tax Cuts and Jobs Act passed and Nick was talking about 471C. And we were on board for sure. But we got a lot of the IRS was trying to scare the shit out of us, and most of us were scared, and we were scared too. But we did it anyway because it was the right thing to do. So here we are. Now we have the possibility of amending returns and reclaiming all these lost deductions. So the statute of limitations right now is 3 years. So for a timely filed and paid corporate return, the statute of limitations is October 15th, if an extension was filed to it, and so that time is running out right now. We've only got 3 weeks, and we're all super busy right now with the filing the personal and the corporate tax returns right now. Who is the time to go and do this, right? So protective claim for refund. Now reach out to Nick. Nick, I hope you don't mind me plugging you, but we worked with Nick for a reasonable fee. He gave us what we needed to get protective to argue reasonable basis in like legal terms, legalese. And we have done some protective claim for refunds for our clients where we have told the IRS through a letter, hey, we want you to keep the statute of limitations open for this. And there's some people like saying, it doesn't qualify because there isn't any specific open litigation. But you know what? It's certainly better than nothing, right?
There is specific open litigation, right?
There is, right? Yeah.
Provisions. That's the open litigation. It's in the courts. And
absolutely.
It's doing well.
You gotta watch out for the naysayers, man. Like there's so many naysayers online. If you're reading the articles and stuff, there's always people saying, hey, and like even like penalties, people are afraid, you might get a lot of penalties, but we did the research and all of the most popular cannabis court cases, Harborside and the like, they abated penalties for them. They said, hey, if they used a professional, they had a reasonable reason to take their approach, and they got out of penalties.
Yeah, and good records are extremely important. Like Nick mentioned earlier with the audits he's seen changes on, we've kind of seen it time and time again that not having good books and records just as a foundation has been, we've seen the worst results time and time again in the courts. So good records and consulting a competent professional tends to be pretty good protection for the taxpayer. And then along with like disclosures, hopefully you're filing disclosures as well.
So for 2020, you might be able to get a protective claim for refund in. And if it wasn't paid, you have 2 years. Well, go ahead from the date of payment, right, Jamie? Right.
Yeah, 2 years from when it's paid or 3 years from when you filed, whichever is later. There's some caveats. There's some caveats, like if you paid a little now and a little while ago, a little bit. If you're doing the 2 year thing for paying, the refund can only be up to the amount you've paid in the last 2 years.
Yeah. Some people still owe for sure. There's people who owe tons of money right now.
Yeah, and that's a really great point. If you have not paid any, so we have a lot of people we've encountered many clients who just haven't paid their taxes, right? So you may have filed the tax return, but you did not pay. You can still file for like a reduction in your tax balance, but they won't refund you. So it's kind of interesting, the different rules around the statute of limitations.
Yeah. So then we have 2021 and 2022 that are still open for the most part. And so for potentially amending, we're going to have 2023. If you filed a conservative tax return, we'll be able to do that moving forward. Any concluding thoughts? And then it is now 11. We could potentially take another 10 minutes. Nick, do you have 10 minutes for some Q&A?
Yeah, sure.
Okay. Any concluding thoughts?
I'll say this: there's a lot of companies that are doing this, right, Justin, as you said, and we see the IRS. I think you should assume that the IRS is going to challenge you. That said, it doesn't always happen. We're seeing some inconsistencies out there. We've seen a number of clients get refunds. We've seen clients had liabilities wiped out. We've seen a couple clients get audited, right? So we're not seeing a consistent across the bow. approached by the IRS at all here. I do think that notice, though, you have to assume you're going to get audited. And that's what I tell all my clients. And if it still makes sense, then great. But don't put your head in the sand and think that, just because Trulieve got its money back, you're going to get your money back too. And there isn't going to be anything else. Right. So I think that's a wise way to go into it.
Yeah, that's what I've been telling clients is like, we don't really know right now. Like this is all new. And so just assume the risk is high and assume that an audit. But if you've got good books and records, you have a really good tax return prepared. This is what I'm telling my clients. Then you probably will just end up dealing with like a long audit process, right? It's annoying to be audited. I mean, more than anything. But if you're going to save $20,000, $30,000, $40,000, $50,000,
yeah, and I want to add,
I don't know.
And I want to add that for some of our clients that we have been applying, maybe taking the position that 280E should not apply, we still do 471C at the same time. So we do both. We disclose both positions separately. And that way, the IRS can come back and they can say, we don't agree the 280E piece, and we can fall right back on a still, aggressive and strong inventory position. So that's really important to make sure you're covering the bases. We don't know the risks exactly, but in a way, in some ways we can kind of quantify them, right? We know they can come back, they can say, you understated your income and we're going to charge you penalties and interest on that difference. And, hopefully the disclosures protect you from the greater of the penalties, which are substantial understatement penalties, right? The disclosures are intended to protect the taxpayer from that. And oftentimes, as Justin said, we'll see penalties get waived in these situations, but the IRS cannot waive interest. So ultimately, if they come back, they disagree with your position, they change your return and recalculate tax, you will be charged interest on the underpayment of your tax, and they don't have the authority to waive that. So, right, there's kind of a spectrum, right? The risk, the worst risk is they could disagree with maybe all of everything you did on the tax return, but that's probably pretty unlikely. And then the spectrum goes, most likely is they might, disagree or disallow your 280E position, recalculate tax and charge some interest. If they never, for refunds, for amending for refunds, for example, if they didn't actually issue you the refund, then they'll just say no. They'll probably just say no, right? If they do issue you the refund, then again, they might charge interest on that refund. But while we don't know for sure, as Justin said, so, assume the risk is high, but it's pretty unlikely that the risk is anything greater than penalties and interest.
Hey, Jamie, there's some questions in here. I was just looking through a little bit.
Yeah.
Dallas has a question about something. I won't read it, but I want to just clarify something. If you're using the 471C method to get additional costs into recognition, look, 280E still applies, right? So there's no deductions until 280E doesn't apply.
Right.
So you're still putting everything that you want to get credit for into cost of goods sold, right?
Exactly.
That's important to understand. And then the other thing that's important to understand is you can't just write everything off at the end of the year. That's inconsistent with a method of putting things into cost of goods sold. You have to have a year-end cost of goods sold that gets carried over to year two, right? That is a consistent accounting method, and it's very important that you follow that method. Now, look, when 471C first came out, a bunch of cannabis CPAs took the position that now we can write off our ending inventory. That's a legitimate position under 471C as well, but that is not consistent with putting additional costs into cost of goods sold, right? And so it's sort of one or the other. If you want to take that, if you're taking a position of expanding cost of goods sold under 471C, that the writing off the year-end inventory is something that could be available once 280E doesn't apply, right? Once that happens, now we can get to a position like that. That might be your 2024 return, right? But in the years when 280 applies, we need to be consistent with an inventory method of putting things into cost of goods sold. And that means year-end inventory carried over year two as well.
Yep. Yeah, on the chart of accounts, we put everything we're going to deduct into cost of goods sold, and we capitalize some of that inventory.
Right.
Yeah, it's
exactly.
we
Yeah,
work
and so that's a great point, Nick. Just to also touch on that a little further, we have seen people, different accountants and stuff, who might do a really big adjusting journal entry at the end of the year, right? And they'll say everything that was below the line, all their overhead expenses, we're just going to reclassify them up to cost of goods sold. That's not really going to fly. That's not books and records matching. That's a tax adjustment at year end. So we really do recommend, adjust your chart of accounts, make all the accounts that you're hitting, put them up in cost of goods sold on your P&L, make inventory adjustments, do all of that. So your position really is that your books and records do match the tax return. You don't want
Jamie, that's critical, right? That's essential. It's essential.
That's the position, right? That is the position, is that your books and records match, right? So you don't want to be doing, a big sweeping journal entry at year end. No, that's not going to really fly. I wouldn't recommend that. I recommend really adjusting everything, make it all match, make it all consistent, as Nick says. File that 3115, do it right so that your position is strong.
Yeah. One of the things that it says in the regulations is that 471C is the method of accounting that is used in your day-to-day business. Mm-hmm. It specifically says it's not the method. It's not a tax method of accounting. Right. It is the actual method that you use in your day-to-day business. Yeah. So what is that? That is you can't journal entry it up at the end of the year.
Your tax preparer throw in a journal entry. That's not day-to-day. No.
Yeah. Hey, Jamie, there was something else in here about some questions about rescheduling. Look, rescheduling is medical, right? That question is, is it a medical thing? It is. let's Schedule 3 is a medical thing, right? Mm-hmm. And it enables the Schedule 3 industry, which guess what that is? That's big pharma. It does nothing for adult use, zero. Yeah. And as a matter of fact, if we're right on 280E going away when the HHS report came out, here's my question: do we want rescheduling at all? If the only thing rescheduling did was get rid of 280E, and that's already happened, are there any further benefits, or is it all just exposure for our clients because now Big Pharma is going to jump in and start to sell Bubba Kush at Rite Aid, right? I don't know, but I think it's a good sort of rhetorical question for us to ask.
Nick, we'll get on another recorded video of the philosophical. Our clients definitely should be wary of Schedule 3. The only thing that it does is it gets rid of 280E. That's it. But then it might expose the industry to other challenges, maybe more costly challenges. I think the THCA, the hemp right now, is really bad for the regulated market. That's a different conversation too, right? I mean, we can go on and on to the challenges of the cannabis industry.
Yeah. And so Gene asks, are you guys amending returns now back to 2020 since they're still open? And yes, Calyx is amending some tax returns for clients that are open to it.
We are right now. I mean, if you've got clients that may have filed last minute, consider a protective claim for refund if you can't amend their return. And again, reach out to Nick for language to include in your tax returns. Mm-hmm. Yeah. All right, guys. I think we done did it. Do we want to spend a little bit more time on questions? Oh, there we go.
Hi, Nicole.
Do you want to post the questions up and answer them, or?
It looks like we kind of got most of them covered, I think.
Yeah. Someone asked about literature on 471C. No, we don't really have anything. I mean, we definitely recommend everybody reads the code, read the regulations. There are some articles out there that touch on it and why, maybe the regulations aren't really valid and disallowing 471C, but there's not a lot out there because a lot of people are kind of afraid to kind of publicize that position. It's a lot of just
really just this meeting is probably the most informative thing that you're going to find on it. So, all right.
Yeah.
All right. Well, thank you so much. We appreciate you getting the word out there through Tax Practice Pro. Thank you, everyone who attended this afternoon, and have a great afternoon.
Yeah,
Thank
and
you
feel
much.
free
Thanks,
to.
Nicole.
Thank you for Tax Practice Pro for their support of the cannabis industry for so many years.
Yeah, and I just wanted to say people can email if they've got other questions. Feel free.
Hey, Justin, I was in that that John Sheely presentation in that basement of the hotel in Denver back in 2014.
Shit, really?
as well. Yeah.
Oh, okay.
Yeah.
You weren't one of the speakers, though, I don't think, or were you?
I was not. Later on, John and I did a bunch of that together, but in that
Probably-
one, I was
I
trying to
probably
learn.
didn't even know it, but you're probably the one who was like, "Hey, there's things that we can do here," you know. But at first, it was like there's nothing we can do, and then all of a sudden, it was like a roundtable of how do we do this? What are we gonna do? So it's good. It's very good. All right.
All right.
Thank you, everyone.
Hey, everybody.
Good stuff. Thanks, everyone. Have a great afternoon.